debt is a magnifier of outcomes, right? If it's a positive outcome, it makes it even more positive. If you have a negative outcome, it magnifies that too. The more debt you put on the spreadsheet, the higher the returns are generally going to look, right? So you might say, well, if we add more debt, it's a better deal, the returns are higher, but of course, it also is higher risk. So you want to analyze that sweet spot and figure out, okay, well, what's the right amount of debt where it's accretive for returns, meaning the returns are enhanced, but without pushing ourselves into a level of risk where we're not comfortable or where it's no longer worth it.
Hello, folks, and welcome to the show. I'm Ravi Gupta, COO of Viking Capital Investments. As some of you may know, there's recent news of a Ponzi scheme surrounding a group called Freedom Impact Consulting, LLC, regarding an oil and gas syndication. Many of the investors were high net worth individuals, such as the listeners to this podcast, and they were sold on the deal being phenomenal. High returns, little risk. Unfortunately, the deal collapsed. And this begs the question, what is a Ponzi scheme and how do you catch one? Well, a Ponzi scheme is a fraudulent investment scheme that promises high return to investors with little or no risk. The scheme operates by using funds from the new investors to pay returns from earlier investors, rather than generating legitimate profits through legitimate business activities. The scheme eventually collapses when the inflow of new investors stops or slows down and the operator is unable to fulfill promised returns. Well, now the question is, how do you catch one of these Ponzi schemes? Well, the way to do this is through thorough underwriting. So when I first started Viking Capital Investments, a lot of our investors were asking this particular question because they didn't really understand what multifamily investment was and how people were able to achieve such high returns. And this is one way to do it, is to understand underwriting. And to help us understand underwriting, we have with us Rob Beardsley of Lone Star Capital. And in fact, Rob has written the book on underwriting, and I have that right here in front of me. For those, there you go. For those of you watching the YouTube, it blanked out a little bit because I've got this background here, but Rob wrote the book on multifamily underwriting, and he's here to talk to us about underwriting and how we can understand the deal and protect ourselves. Welcome, Rob.
Thanks for having me on the show.
Absolutely. Happy to have you. So let's talk a little bit about yourself first. Just introduce yourself to our listeners. Tell us your experience, who you are, and what you do.
Sure. So as you mentioned, my name is Rob Beardsley. I'm the founder of Lone Star Capital. We're a 5-year-old multifamily investment firm based here in New York City, focused exclusively on Texas workforce housing, primarily in the Dallas, Fort Worth, and Houston markets. And as I mentioned, we focus on workforce housing, which for us, that's more so kind of middle of the road, B-class housing, suburban garden style assets. And 2 years ago, we also brought property management in-house. So our entire portfolio, which is now approaching 500 million in assets, is entirely managed in-house by our own property management team.
Oh, that's phenomenal. So let's maybe just walk us through underwriting. What does it mean to you, and what are you looking for when you're looking at a deal?
So the essential core of underwriting is evaluating the potential returns of an opportunity. So it really starts as simply as looking at the current financial picture and then making projections about the future, which is when things start to get a little bit more nuanced, because obviously the present is the present. There's only so much manipulation or analysis you can do with the current numbers, but the nuance really goes into the underwriting projections for the future performance of the property, which can include your business plan of renovations on the interiors and the exteriors, changing management practices, reducing expenses, and so on. So that's where a lot of the effort is in underwriting. But the essential core practice of underwriting is looking at an opportunity and analyzing either if you would pay the asking price or what price would you pay for that asset. And that's based on, again, the future projections as well as more subjective risk analysis and deciding, well, are these potential returns worth the effort and risk that I'm going to have to take in order to potentially achieve those returns?
Absolutely. And, it's really important, kind of stepping back here, it's really important to trust the sponsor that you have doing the underwriting. Because, as we discussed previously, if you're investing in a deal that you may not know much about and you're trusting the sponsor to do the underwriting properly of this deal, then you're putting your full faith in them and all of your money in them. And if they don't perform or they lie to you or say something that's maybe not true, then you're out of all of your investment money potentially. So you really want to trust the people doing what Rob is discussing. So basically, in essence, Rob, it's looking at the deal from a, stepping back, looking at the deal from a perspective of whether it's worth the cost of acquiring the deal, how it's going to perform through time, what kind of business plan you're going to implement. And then when you sell it, if it makes sense to sell after your business plan has been implemented. Or maybe the business plan is just to hold the asset and let the property grow organically. Whatever it may be, that's what you are doing when you're underwriting. You're projecting what is going to happen over time. So what are some of the metrics that you follow when you're underwriting?
Yeah, there's really so many metrics, but I think as far as return metrics, you can really boil it down to looking at the return on cost, which is a very basic yet essential element of valuation. And so return on cost is simply your future projected net operating income. So the future income of the property after you implement your business plan divided by the purchase price of the asset, as well as the renovation costs required to push the property to that future NOI. So that gives you an unlevered yield, very similar to a cap rate, but it's kind of the future cap rate of the property, which cap rate is also a good metric, but it's lacking that more information as far as the future, because a lot of us talk about cap rates, but if we're talking about in-place cap rates, it doesn't speak to the opportunity of the deal, right? So just because a property has a low cap rate today doesn't make it a bad deal. And just because a property has a high cap rate today doesn't make it a good deal either, right? It's all about where you can take the asset. So if you can buy at a reasonable cap rate today, and then through your business plan, push the income to a strong return on cost, also known as yield on cost, you can be in a really strong situation, with a good deal on your hands. So yield on cost or return on cost is something that we focus on, and we want to make sure that there's some sort of spread between the yield on cost as well as our cost of financing, which brings up a really topical point, which is the topic of positive leverage. These days, investors are all talking about positive leverage, and that's because interest rates have risen to a point now people are really cognizant of their going in value. If you rewind a year and a half ago, investors were much more confident about the future, and they are much more willing to pay a lower cap rate today on the assumption of growth tomorrow, right? So they could buy a low cap rate today, but through growth, they can get to a good enough yield on cost where the returns are strong. Today, however, investors aren't as bullish. And so they're more stringent on wanting to buy a property with a higher cap rate today than the cost of debt, so they can achieve what is called positive leverage. So the nuance I want to share there is that positive leverage isn't everything. If you don't have to buy a deal on positive leverage today, or if you buy a deal on negative leverage going in, it doesn't make it a bad deal. It all boils down again to your return on cost. Can your business plan justify getting the income up to a high enough yield on cost to then be in positive leverage territory? So
Rob, this is great information, but can you share like a very easy example to the listener so they can understand it better?
Yeah, sure. So let's say we're buying a $10 million property, and the current income of the property is $500,000. So that would mean the property is being sold at a 5% cap rate, because 500,000 divided by 10 million is 5%. So if you bought the property with no leverage, you just paid $10 million cash, you could expect to receive 500,000 per year in income. So you get a 5% return on your investment every year. So that's what a 5% cap rate is. However, as you know, we're not in this business for a 5% return, right? We want to be able to push the income and achieve better results. So before we talk about debt, let's say through our business plan, because we're savvy, we've been able to identify an opportunity in the market. Maybe we can push occupancy, push rents, reduce expenses. We can take that. I'm just use a dramatic example. Let's say we could take that $500,000 NOI to $1 million. We can double the income of the property. Now that's a 10% not cap rate, but 10% yield on cost. However, let's say that it costs some capital in order to renovate the interior such that we can push the rents and grow the income to $1 million, right? That might require, let's say, $2 million of renovations. So now we would actually take our $1 million of future income and we would divide it by the purchase price plus the renovation budget, which would be 10 million plus 2 million. And we would be left with our true yield on cost metric there. That would be 8.3%. So an 8.3% yield on cost is tremendous. That's a very, very good deal in today's market because we don't have to buy deals all cash. We can actually use debt. And today we can borrow at long-term rates of, call it 5.5%. So if you can stabilize at an unlevered yield of 8% plus and your cost of debt is 5.5%, that's a very big spread to where you'd actually be able to generate cash on cash returns of over 10%. So now we're getting a great levered cash on cash. And because we increase the NOI of the property, the value of the property is higher. So when we sell, we can also make a big profit there. So that's kind of the math behind yield on cost and the general concept of value add real estate.
Yeah, this is wonderful because a lot of people don't understand this as you explained it. And it's a pretty simple concept and it's something that people could do themselves because they know what the property is going to cost. So they ask for that. Then they ask for the budget and how much CapEx expenses and then how much it would cost to close the deal because it's not just CapEx expenses. There's other expenses on top of it. Typically the sponsor will take an acquisition fee, which is the fee paid to the sponsor to put the deal together. And, there may be some other associated costs, legal costs, other transactional costs and that type of thing. So you can ask the sponsor, hey, so what is the total cost of this deal after it is purchased? And then ask them what the cost is, what for cost they're projecting the exit to be. Then you can also figure out, what their net operating income is currently. You can figure out the cap rate, the net operating income divided by the value of the property. And then you can figure out the cap rate in the future. And then you can calculate the yield on cost. So this is excellent. So just some simple numbers and you can figure out, what these ratios are. And you said 8.3% is good. Like, is there like a kind of a rule of thumb? Like what are you looking for?
Yeah, it's a good question. And 8.3 is fantastic. That's an amazing deal. However, one thing that we have to make sure that we are always talking about is risk. Because just because if I presented you or an investor two deals side by side and one of them had an 8% return on cost and another deal had a 7% return on cost, right? Without knowing any other factors, you'd obviously say, well, the 8% return on cost deal is better. However, we have to look at the deals on a risk adjusted basis because if the 8% return on cost deal requires us to take double the amount of risk and maybe we have high vacancy and crime and mold and deferred maintenance and things like that, you have to ask yourself as the investor, is it really worth that extra risk just to get that extra point or 1% in return on cost? It might be, and it's very subjective. It's all in the eyes of the investor. So that's something that we spend a lot of time focusing on. So when I say a certain percent is good, we have to understand the risk profile of the deal. But generally speaking, when you have kind of I'd say average risk deal for a 1980s vintage multifamily value add, let's say in a primary market, in one of the top 10 markets in the country, these days, a 6.5 to 7% return on cost is quite good. That is positive leverage territory. And since you're in a top growing market, you can expect to stabilize at that, let's say 6.5% number. And then hopefully through the strength of the market, your rents will continue to grow year over year to continue to push your operating cap rate such that when you do exit the property in 3 to 5 years, you're able to get mid-teens returns for your investors. So investors could receive, 15% IRR or approach doubling their investment in 5 years. That's kind of the industry standard.
Now, how does leverage play into this? And also, I know you spoke about positive leverage, but if you could just once again explain positive and negative leverage, what that means and how it plays into the calculations, because, you may have like as you mentioned, like a 8% return on cost deal versus 7%. But if one deal, the 7% one, you have amazing leverage versus the other, maybe the 7% is better.
Yeah. Yeah. So we're definitely going deeper here. So with return on cost, right? Those are very basic ratios that don't even take into account debt. So you can get a lot of evaluation done before you even factor in debt. But then once you introduce debt, that's a whole nother layer of variables to analyze. And debt is a magnifier of outcomes, right? If it's a positive outcome, it makes it even more positive. If you have a negative outcome, it magnifies that too. The other thing to understand specifically as it relates to underwriting is the more debt you put on the spreadsheet, the higher the returns are generally going to look, right? So you might say, well, if we add more debt, it's a better deal, the returns are higher, but of course, it also is higher risk. So you want to analyze that sweet spot and figure out, okay, well, what's the right amount of debt where it's accretive for returns, meaning the returns are enhanced, but without pushing ourselves into a level of risk where we're not comfortable or where it's no longer worth it, right? So those are the types of analyses on the capital market side that we spend a lot of time with our lenders and brokers and internally to put together the right capital structure. So that's how leverage plays into kind of the underwriting and risk. And then as far as just covering positive and negative leverage, it's actually quite simple. If you have positive leverage, that means your cap rate or your unlevered income relative to the price, like for example, we said we had a 5 cap deal where the income of the property was 500,000 and the property value was 10 million. If you have 5% cap rate and your cost of debt is 5%, you actually have neutral leverage. And what that means is your cash on cash return will be 5% because you're not magnifying returns, but you're not diluting them either. It's just you have a 5% unlevered return and you're leveraging that with 5% debt, and it just cancels out to where you get 5% cash on cash on your equity. Now, if we bump that up to a 6% unlevered return or cap rate with 5% debt, now we have a positive spread of 1%. So we have positive leverage of 1%, and we could actually take our unlevered return of 6%, and through the power of leveraging 5% debt, we could actually get a maybe 7% or maybe 7.5% cash on cash. So now we're magnifying returns. But that magnification, like I said before, works in reverse as well. If you buy a 4% cap rate deal, but your cost of debt is a point higher at 5%, that'll actually take your unlevered return of 4% and notch it down to maybe 3 or 2.5%. So those are the concepts of positive, neutral, and negative leverage.
Yes, and this is why the prices of multifamily skyrocketed over the post-COVID time period, was because the cost of debt dropped so significantly. Like we started getting around 3% interest rate on debt. So the cap rates on multifamily were around 5% initially, then dropping to 4%, and then dropping to low 3s, and sometimes even dropping below 3%. I mean, there are deals out there, especially in markets like Phoenix, where you'd have deals below 3% debt, and that's negative leverage. What the sponsors were thinking was, yes, I'm paying a lot for this, but I will put a lot of money into it. The business plan will improve NOI, and then as Rob was mentioning, your yield on cost will increase because you're putting so much money into it. The NOI is increasing so tremendously that the deal makes sense at the end. So now what's happening is the interest rates have gone up. The cap rates were initially low. So now people are realizing that they can't sell at these low cap rates, and they can't transact at those low cap rates. So cap rates are going up and up and up as the debt is increasing. So as you were discussing, there's an interplay, right? You have cap rates and interest rates on debt. It just kind of oscillates back and forth depending on the market. Now, what about, that's getting a little bit in the nuance of debt, but I think it's important to discuss, what about interest-only debt versus non-interest-only debt? How does that play into this?
Yeah, so just to define those terms, if you have debt that's interest-only, that means that your debt payments are only interest payments. You're not paying back any principal in your monthly mortgage payment, which means your payment overall is less than if you were to have a amortizing loan, which means that every single month you are paying back a piece of the loan on top of interest, right? So from a cash on cash perspective, with an interest only loan, you're going to see higher cash flows because you're paying a lower mortgage every single month. But from a total return standpoint, there isn't that much of a difference, because whether you are paying back a piece of the loan or not and just receiving additional cash flows, you're earning that equity either way, right? If you're paying down the loan, that's just going to increasing your equity. So from a total return standpoint, it's not a huge deal. From a cash flow standpoint, it is a big deal. And as you and I know, investors love cash flow, and anything we can do to enhance cash flow, we want to do that. So we try to opt for as much interest only that a lender is willing to give. So that way we can maximize cash flow for our investors. However, when it comes just to cover a quick little nuance as far as underwriting, something interesting to understand about the very famous IRR calculation, which is your internal rate of return, which IRR is the gold standard return calculation across all private equity and real estate. However, it's a very complicated calculation, and it's kind of subject to some manipulation. So for example, the more cash flow a deal has, the higher the IRR the calculation will assume the IRR to be. And that's because when the IRR calculation is run, it assumes that cash flows are reinvested back at the IRR rate. So for example, if you have a deal that's projecting 15% IRR and you're kicking out some cash flow back to investors along the way of, let's say, 5%, the calculation is going to assume that those investors are able to take that 5% cash flow and go and reinvest it at 15%. Now that may or may not be true, right? Practically speaking, if an investor gets back $1,000 every month, are they going to take that $1,000 and invest it at 15%? Maybe not. Maybe it sits in a bank account. Maybe it goes into a high yield savings. So there's some leakage or some imperfections with the calculation. And the higher your cash flow is, the more that imperfection shows up, right? Because it's using more cash flow and assuming more of that cash flow being reinvested to generate that total return. So that's a super big nuance that I think is more so like a nerdy math thing that people may find interesting, but practically speaking, it's not all that useful. But that's how amortization versus interest only could affect, your overall return calculations from a mathematical standpoint.
Yes. Yeah. Thank you for that. And, many investors, especially most of the ones that we deal with, aren't as focused on IRR. As Rob mentioned, IRR takes into account time value. They really want to see equity multiple. So most of our investors are looking at, like, say, a 2x equity multiple after 5 years would be more impressive to them than an IRR of like 14, 15%. Like that doesn't mean as much as the equity multiple. But it is important to know what that means. When people are mentioning the IRR, a lot of institutions just go by our IRR. That's, their primary focus. They care about the time value. They want to see very high, quick returns so they can reinvest that money, as Rob was mentioning. So, okay, Rob, so we've got the yield on cost. We've got the cap rates. You spoke about positive and negative leverage. You spoke about debt. What other metrics do you look at when you're evaluating properties? And then also help the investors to understand what can they look at to make sure that, this isn't a Ponzi scheme, or this isn't something where they're going to be where the sponsor is going to be taking some money and giving it back to them.
Right. So one other metric would be cash on cash. And we touched on cash on cash when talking about interest only payments and positive and negative leverage. So cash on cash is simply the amount of cash flow that's being distributed on a monthly or quarterly basis back to the partners of the investment. And for us, cash on cash is really important because, as we discussed, our investors really value cash flow. And so the more cash flow we can deliver, the happier our investors. Now, of course, over a long time period, the IRR and the equity multiple are really important. But when you're talking about the first 6 months, 12 months, 24 months of a deal, you're often just seeing cash flow. So cash flow is important in that regard as far as just an investor preference. But it has another important element, which cash flow is a risk mitigant, and it's also kind of an indicator of a quality deal, right? If I have a deal that has pretty strong cash flow projections and it's underwritten, conservatively and well, then that's most likely a higher quality deal than a deal that has lower cash flow, but yet arrives at the same return, right? And that kind of goes back to the concept of deals aren't created equally, right? If I have deal number one and deal number two, and let's say both of them have the same IRR, right, of 15%. Well, that doesn't mean they're the same deal, or that I would pick in that circumstance the deal with the higher cash on cash, because all things being equal, even if the total return is the same, I still want the deal that has more return coming from cash flow, because that's actually lower risk to me than if I were to, let's say, have to rely on a sale in 5 years' time to earn my return, right? If it's pretty straightforward, right? Logically, if I have to sit there and, let's say, get no cash flow for 3 years, and then after 3 years I get my return and that's how I get my IRR, or every single month starting from the first month I just get solid cash flow for 3 years, obviously I'm going to take the 3-year cash flowing investment. And that's kind of shows the difference between value add multifamily, where you're buying an existing cash flowing asset, versus development, right? Development is a great business model, and if you do well on a development, you can get very big returns, but you have the added risk of the development process and the simple fact that you're foregoing any cash flow for what could be 2 to 3 years.
Excellent. Yeah. So cash flow is huge. Cash is king, as they say. And, something to also ask your sponsor is, what is the cash flow the deal is producing? Oftentimes, and we do this too as well, and other sponsors also do this, we buffer our operating account with enough reserves because we want to make sure that there isn't a period of time where we maybe we haven't noticed something, there's some maintenance issue that we didn't catch, and we don't want to go back to the investors and have a capital call. We buffer the operating account with a certain amount of funds. And sometimes we put those funds into the property so the deal cash flow is it looks like a cash flow is a little bit more than it may actually do in the beginning as we're implementing the business plan. And that's purposeful. It is intentional, but it's not something that's done for the whole period of the hold. It's only done for a short period of time. We're implementing the business plan, and then the deal cash flows on its own. So ask your sponsor, hey, what is your style? What do you guys do? How are you achieving this cash flow? Where is the cash coming from? Make sure you ask all those important questions so you can understand the deal. Because, like some of these deals that are Ponzi schemes, you ask them that and they may not have the right answers, or maybe their answers don't make sense, and if it doesn't make sense to you, you shouldn't do it. And I that's why I love multifamily, because it's very straightforward. It's like, hey, look, the tenants living there, they're paying rent, there's expenses from that, and the rest is profit. It's simple, straightforward. Something like, I don't know, like some other companies, oil and gas, as we discussed before, something else that we may not totally understand, it's much riskier. So either don't do them or just put a little bit of money, diversify, right? Just test the waters. Make sure that you're not putting all your eggs in one basket. Excellent, Rob. And anything else aside for cash flow that we should know at a high level when looking at the deal, looking at risk?
No, I think those are the main metrics. And, you have a good point about distributions and where are they coming from. It's become more common in the industry, like you mentioned, to help out the cash flow for the first year with reserves, right? Which when you hear it for the first time, and certainly when I heard about this for the first time, I thought, oh my gosh, that's a Ponzi scheme. Why are people doing that? That's wrong. But over time, we've understood that it's actually, number one, it's simply not a Ponzi scheme. But number two, it's not harmful to investors. And so I'll explain why. And once I understood these factors, we've also started to, like you said, buffer reserves and provide extra cash flow in the first year just to make sure that the property is not struggling to provide that cash flow. So number one, the way that our preferred return and our waterfall is set up is such that all distributions are treated as first to satisfy the pref and then to return capital. So it's not like we satisfy the pref, and then have a promote, at the end of the day, investors don't pay us any performance compensation until they've earned a minimum 8% compounded return and they've gotten their original investment back. Only then do we begin to share in the profits. So that means that, number one, if we have to raise more capital in order to have the high enough reserves to be able to help out cash flow for the first year, so that cash flow, instead of being 3%, is, let's say, 5%, that goes towards calculating their preferred return, right? We had to raise more capital. So now investors are owed a preferred return on that higher amount of capital. And then when we pay out those dollars, they just go towards the pref and returning capital if you meet or exceed the pref. So that's kind of point number one. And then another thing that you said was really good is actually asking, okay, well, what is the property's cash flow ability without any support? What's the true cash flow month one, year one? Understanding that as an investor is valid and very helpful. And so if you go into a deal eyes wide open, for example, and understand, okay, well, actually the true cash flow of this deal is only 2% in the first year, but we're beefing it up to 4%, and that's being done through, let's say, $100,000 or $200,000 of reserves, right? Understanding that picture gives you more clarity. And like you said, is this a Ponzi scheme? Where are the returns coming from? If you can identify those components, then the numbers can make sense, right? If you're staring at a spreadsheet where there's this much cash, like true cash flow, but then the projections are showing this much cash flow, that's a scary picture, and you want to understand that. Why do we do this? Why has the industry moved towards doing this? And the simple answer is because the market is pushing for it. And whether that's right or wrong is up to people to debate. But the reality is, investors, in a circuitous way, they want this because they will go and invest with the sponsors that do this, right? Because investors want cash flow, so they will find the sponsors that do this. You might get left behind because all the investors are going to invest with sponsors that are providing, frankly, a better customer service or customer experience because they're more attuned to investor needs, right? Investors are very sensitive to cash flow, as we discussed. And if we can help them by raising a bit more capital to provide that, even if they know that it's simply a return of a portion of their capital, our investors are still very excited about it.
Yeah. And the important point is you should know, any sponsor should tell you this up front and tell you that, hey, look, this is how we operate. This is how we do things. This is where the cash is coming from. And what it also does is it allows you to have a buffer, right? So there's a buffer that can be used for whatever you need it to be used for. An example is many years ago, we had a property that we acquired. We had no idea that some of the retaining walls were about to break. And we did our due diligence, we did our physical evaluation of the property, and we just missed it. So it was a tremendous cost to replace some of these areas. But once we did, because we had those funds available, we were able to do so. So, there's benefits to this. You just have to know, as an investor, you have to know that this is happening. This is understanding cash flow. And this is understanding, hey, look, this increases the cost basis, but at the end, you still get, a good return. And that's what really matters. What else, Rob? Anything else you want to share for our audience? Any other tips?
Well, you kind of got me going on this topic a little bit. So just to add one more point.
Yeah, please do.
So let's go to the reverse. Let's go in the opposite direction. And let's say, what if we want to not maximize cash flow, but minimize cash flow? Because if you really want to go by the book, if you're doing a value add plan, why would you even distribute cash flow when you could use that free cash flow to actually reinvest it back into the property for your renovation budget? To use an example, let's say a property produces $300,000 in free cash flow per year, and you have a renovation budget of $1 million. Well, instead of raising your $1 million renovation budget, you could raise only $700,000 and then use the free cash flow of $300,000 for the first year and pay no distributions for the first year. Do your renovations, spend the $1 million, $700,000 coming out of raised funds, $300,000 coming out of cash flow. In the end, after that year, you would have raised $300,000 less, So your investment would be overall more efficient, right? You would have a higher total return because you more efficiently performed your business plan, but for 12 months you sat there with no cash flow. So that's the opposite. That's kind of going to the other end of the spectrum. So as an investor, when looking at numbers, you have to say, okay, is that the kind of deal I want? And some people have no need for cash flow and are savvy enough that they want to find deals that fit that description. And that would be kind of more like development, because frankly, nobody in the value add space does what I just described. And there's a reason for it, right? Because people love cash flow. So I'm just kind of showing kind of the spectrum of ways to analyze cash flow and ways to utilize cash flow.
Yeah, absolutely. Actually, I saw some development deals where they would offer the investors cash flow for the first several years. And I questioned the sponsor. I said, how is this possible? How's the deal cash flowing? And they said, oh no, this is all money that we've raised and we're giving that to the investors. To me, that doesn't make as much sense. Now, I'm not, no judgment, or, I'm not saying what they're doing is wrong, but it doesn't make sense to me, is because, a development deal is one, as you mentioned, is one where you're investing for future profits, right? You're not investing for cash flow right away. And those future profits can be very high. Development deals, very often do much better than standard value add deal. But again, there's risk and you're not cash flowing upfront. But if you add cash to that by this method, you could do it. But for, personally, my thought is then it becomes a hybrid and it doesn't make as much sense to me. I don't know if you've seen that out there, Rob, yourself.
Yeah, I think I may have seen that actually as well. And I agree. It kind of is not in the spirit of this strategy, right? It's going too far. At the end of the day, if you're raising $10 million and $2 million of it is to pay back investor capital through cash flow, that's a big, big number, right? But if you're raising 10 million and only 200,000 is to bolster distributions, that's a different story.
Yes, absolutely. Excellent. So we discussed underwriting, some pearls that you gave us, and some definitions of certain terms. We discussed understanding the investment, making sure that you really take time to understand how the investment works. Both Lone Star Capital, I'm sure, as well as Viking Capital, has an investor relations team. We're happy to answer any questions that you have. Happy to even talk to you about other deals that you might be thinking about doing and you have questions about. Please reach out to us and we're happy to do that. And then we also spoke about diversification. Make sure that if you are investing in something that you don't totally understand, don't invest everything. It may be small little chunks if you really want to do it to see if it works. There was a project, speaking of which, there was a project in the CBD space that I invested in because the returns just looked unbelievable. And this was like, 4 years ago. And I was like, oh my God, I put, certain amount in now, I'm getting like a 10x equity multiple. And it almost looked too good to be true, but I just jumped on the bandwagon. But I was like, you know what? I'm not going to put in a lot. I'm just going to put in a little bit. And unfortunately, that deal never panned out. I've gotten nothing from that so far. And hopefully I'll get my investment back, but I'm glad I just put in a little bit. And, it's a way to, diversify and try something new. And I learned from it, but this is what you should do when you're investing in deals that you don't understand. Anything like that happen to you, Rob, where you invested in something and it just didn't pan out?
Absolutely. Yeah. It's a great lesson. Obviously, you and I, we have our expertise in multifamily, right? And that's where we feel comfortable. So I'm sure both of us have a dramatic weighting of our personal investment funds into multifamily in our deals, as well as other people's multifamily deals, right? And that's number one, it's because we are in the business, but two, it's because what we understand, right? And what we understand, we have a lot more confidence in. And so you can throw around a lot bigger numbers. But yeah, just like you, I've also kind of listened to the advice of others and thought, oh, well, this sounds amazing. If I just put in a smaller amount, like $25,000, I can get a big return here. And this is game changing. And because we don't understand that business model, we don't ask the right questions, and it's much easier to make a mistake. So yeah, I have a similar investment I made and I haven't seen a dollar either. So to me, It's a cheap lesson, right? Yeah. And definitely worth it because it kind of I'm a big focus guy. So I think diversification is important, but if I can really focus on my expertise, that's how I can be the most successful.
Absolutely. Yep. Absolutely agree. Well, thank you, Rob. This was wonderful. Really appreciate all of what you shared today. If people want to get in touch with you, how would they do so?
You can learn more about us at Lone Star Capital on our website. We actually just did a total rebranding, have a beautiful brand new website. You can check it out at lscre.com. On our website, you can get a free download of our underwriting model that we use to analyze, at this point, thousands of deals. And you can also get in touch with us on our website as well.
Thanks, Rob.
Thanks.